Welcome to the Brisbane Property Podcast with your hosts Melinda and Scott Jennison.
Hi everyone, and welcome to another episode of the Brisbane Property Podcast. Melinda and I are having a bit of a chat today and giving some tips on some ways that we help select property in the current market conditions.
Yes, look, we are in very different conditions, and I welcome you back to another episode of the Brisbane Property Podcast today. When we look at the last 12 months, we've seen 10 consecutive interest rate rises occur throughout Australia. That's changed the game for a lot of property investors. So today, this is going to be an information-packed podcast. It's going to teach you some of the investment fundamentals, and we are going to get down to a suburb level in Brisbane to help you understand areas where we believe are going to be at-risk locations, and even areas where we believe are going to be much safer locations in terms of investing in a higher interest rate environment. The game has definitely changed, Scott, and for a lot of investors that have only ever experienced interest rates declining, this episode's going to be absolutely invaluable in helping them understand the new market conditions.
Now, we've got a lot of data and a lot of information. Before we start off, I do want to thank Pauline in our team from putting all this information together for us. Pauline does a lot of work behind the scenes, so thank you very much. And it's interesting when we look at a lot of this, and when you talk to people about what they look at or what they look for when they start looking at property. And we're from the people that just do realestate.com and look at those nice, pretty touched up pictures on realestate.com, right through to what we sort of help our clients with, and some of those things like avoiding flood and those types of things. But looking really deep down in that data information that we've got here now to go through, it's quite amazing the information that you can actually get and how you can help people understand what we look for. And that's from things like looking at who lives in the area, what they can afford, what things are costing. The talk of this mortgage cliff, which I think has been around since COVID started. I think that the words mortgage cliff came in, and everyone was talking about those things. So this information will help understand that, and I think it's really, really valuable for people to understand.
Yeah, look, I think also because I am a qualified property investment advisor and not just a buyer's agent, I'm very, very passionate about ensuring that investors that partner with our team understand the fundamentals around investing, and we only ever recommend property investing in a low risk environment. Now, regardless of what is happening with interest rates, there is a way to minimize your risk and exposure as a property investor. And that's something that we're very passionate about educating our clients with when we are partnering with them. I think that there's been so much noise in the property investment space over the last 10 years. There's been a lot of people come into the area, off the back of a booming market post-COVID. We saw a lot of people helping others to invest in property, but the fundamentals in terms of suburb selection or location selection, in my opinion, have not always been accurately understood. And that's why we wanted to bring this episode forward and help buyers understand some of the things that they absolutely must be considering. I'm a part of investment forums. I regularly contribute to the Property Chat forum because one thing that is an absolute alarming for me is that some investors will try to seek advice from Facebook groups or investment forums where they'll simply ask the question, hey, I've got $800,000 to spend in Brisbane, which suburbs should I look at? And then the advice that they get back is, hey, here's a list of suburbs where that budget will buy a house in Greater Brisbane. That's a hugely at-risk strategy, in my opinion, because without understanding some of the information we're going to go through today about those suburbs, it just exposes an investor to risk. When you are selecting property, there must be a goal and there must be a strategy to minimize your risk and exposure. And hopefully what we're going to share with you today adds enormous value and really helps you to understand just how granular you must get and some of the information that you must consider when you are selecting investment grade locations. Because at the end of the day, right now, in 2023, you may only need one or two very good quality assets to reach your wealth creation goals. There's a lot of people that talk about having 10, 20 or 30 properties in a portfolio. I for myself would much rather 1, 2 or 3 quality properties that we know will outperform the market rather than having a high volume of properties that just simply don't perform or put us into a high risk situation. So huge amount of information we're going to go through today, and I hope you get a lot of value.
Yeah, it is. I can't sort of back that up so enough what Melinda's talking about. Investing in property, it can make you or break you. I mean, your first investment is absolutely critical. If that goes right, obviously it helps you, your stepping stones to what you want to do next. Some people will balk at that and stop after the first one if it's not a good one and say, oh, no, I didn't like it or it didn't work well for me. So you want to make sure that first one is very, very important. And as you've sort of touched on there, you go out with a brief, you understand where you want to buy, why you want to buy, and know the purpose of that, not just, oh, I've got this amount to spend and that's what I can afford. So here's a property at that amount of value and this is what it's going to cost, and you go and buy it. Because if there's no strategy behind it and there's no purpose behind it, you're just sort of throwing a dart, really. You're gambling, basically. So the information that you've got here, and we'll run through some of that now to help people understand some of the things and some tips that we sort of look for when we start to analyse and look through property.
Yeah, get your pens out and get a notepad ready, because we're going to add enormous value in this episode. Now, just for complete transparency, this information has been taken from the Australian Bureau of Statistics census data that was completed in 2021. So already some of this information is a couple of years old, and we're going to be able to adjust for some of the information that I share with you. And I'll make a note of when there have been adjustments made. But the first thing that any property investor should be looking at a suburb level is the proportion of people that own their property outright. Now, we can look at the number of owner occupiers in an area, but what we want to understand at a more granular level is how many of those owner occupiers have no mortgage. Now, you've got to understand that in an environment where we've got much higher interest rates, there's going to be suburbs that are much more exposed based on a much higher level or proportion of mortgage debt versus other suburbs where the proportion of people that live in that location, a lot of them might own their home outright. So we've taken this data and we're not ranking. This is reserved for our clients, but we're going to just give an example of some of the areas where we've got owner-occupier levels that own their own home outright at a very high level, and some other areas where that proportion is very low.
So Melinda's got all the information here. I'll just give you a bit of an idea as well. When we're talking about owned outright, in Australia, we're talking about 31%. In Queensland, which we've broken down that a little bit less, is 29.1%. Melinda's got more information, and obviously when she said get your pens out, here's some ideas of some properties and don't forget we're talking around that 31 to 29% Australia and Queensland wide.
So that is the proportion or the average number of people that own their homes outright across Australia and across Queensland. Now, when we look at at-risk locations or locations where there's a much higher number of property owners at the suburb level that still have a mortgage, we've got locations, and I'm just going to read out a couple for no apparent reason other than they've been selected because they're very low in terms of the number of homes that are owned outright. Pim Palmer, between Brisbane and the Gold Coast, only 9.8% of all owners or all property buyers in that location own their property outright. So that leaves an enormous portion of that suburb that have debt associated with their asset. Redbank Plains, you've got 10.7% of all property owners in that location who own their property outright. Again, an enormous exposure for those that actually have debt against their property. And another area that has been selected for no other reason other than a very low proportion of properties owned outright is Ripley at 11.5%. So one thing that these locations all have in common is that they're all fairly newly established locations, newly built out suburbs, and therefore potentially a lot of first home buyers or property investors have bought into these locations. And therefore they also carry a much higher level of debt.
And then if we move into some probably more established areas, You've got Aspley, just on the north of Brisbane, sitting at 36.4%. You come to Carindale, out towards the east, heading out towards the Bay Area, 45.5%. Chelmer, to the west, 38.4%. Ferny Grove, 37.5%, and Wishart, 36.3%.
So these areas that Scott's just been through, much safer locations because there's a much higher proportion of property owners that have no mortgage. So when we talk about this mortgage cliff that has been reported a lot in the media, these sorts of locations are much less exposed because there's just fewer people in those locations that even have a mortgage. So, it's less likely that they're going to have they're going to be in a situation where they've overextended. So a much safer location, certainly very unlikely to see high levels of forced selling because of a high volume of people that have overextended.
Now, as we go through these, we might just cross over with some of the suburbs mentioned. As Melinda said, that we're just randomly picking certain areas. Some of them we might cross over and we might mention it a couple of times. Some of them might come in new. So of these properties then, percentage rented. So when you're looking at the properties that are rented, again, Australia-wide, 30.6%, and then break that down to Queensland, 33.1%.
So the reason that looking at the percentage of properties in a suburb that are rented, the reason that becomes relevant is that in most cases, property investors will have leverage against that investment property. So in most cases, they will hold a mortgage. So you can overlay the percentage of properties that are rented in a particular location with the percentage of properties that are owned outright. So if you've got a very low percentage of properties owned outright and a very high percentage of properties that are rented, those sorts of locations can be at risk simply if the landlord or the investor doesn't have the capacity to continue to repay their mortgage, especially if they have overextended. There's other things to overlay with that, including rental price growth, which we will get to as part of this episode as well. But when we look at some of the properties that, have a much higher proportion of their population that are owned or the properties are owned by property investors as opposed to owner occupiers. Remember, at a statewide level in Queensland, 33.1% of property owners are investors. There are some suburbs that proportion is much higher. So for example, Caboolture, we've got 42.2% of that suburb are property investors and only the balance owner occupiers. We've got Eagleby, 45.3% of the suburb are property investors. Morayfield, 43.9%. Some bigger numbers now in Pimpama, again, 56.9%. And then Redbank Plains at 57.8%. So more than 50% of the people that own properties in that location are property investors. So much higher proportion of that suburb are renting. And there's other elements that come into play there, because when your rental property becomes available for rent, you are competing with a lot of other properties that might become available for rent at the same time. So if you look at those supply and demand metrics, when rental markets are not as tight as they are right now, you've actually got more supply for the same volume of demand. So that can put downward pressure on prices if more supply was to come in a nearby location. So again, it does bring an element of risk into your investment portfolio.
Run through some more suburbs. Some people might know these. Camp Hill, 28%. So don't forget that 33%, which we talked about. Carindale, 14.8%. And then Chelmer, 16.1%. And if we go out to Tarragindi on the south side, 20.3%.
So these are areas where there's a much higher proportion of property owners that are owner occupiers in that suburb, as opposed to investors that have invested in that suburb. And these are metrics that we definitely should be looking at when we're selecting a location to invest, because these need to be overlaid with all of the other location selection criteria that you'd typically be using to determine whether a suburb is actually worth your investment dollar or not.
So if we go then, once we've looked at what people have owned, obviously owned outright, as we talked about, and what people rent, it's then the affordability side of it. So we start to look at things like how much people earn then. So people earning less than $650 per week and also then earning more than $650 per week to understand that household income side of things for affordability.
So we can look at this census data, which was collected back in 2021. Admittedly, there may have been, some minor shifts in earning capacity since then, although we haven't seen the same level of wages price growth as we have seen in mortgage cost increases due to those rising interest rates. That said, Australia-wide, when we look at the proportion of people that earn less than $650 per week, it's only about 16.5%, and same in Queensland, 16.4%. So very little difference at the Australia-wide statistical level versus the Queensland level. However, when we look at a suburb level, we can certainly see some locations where there's a much higher proportion of lower income earners. And Scott, what is alarming to me is that some of these locations I'm about to run through, they're coming up as a red flag suburb on a number of metrics for me, and yet they're suburbs that I often see promoted and spruiked as great investment hotspots. So this is where I think that it's absolutely critical to get expert advice so that you do know everything about the location that you are investing in. So
yeah, I do hear a lot of, we do, as we talk about, we hear a lot of people talk about it, and maybe it's people that aren't local and don't know the area as well as we do. But when you see some of the numbers and when you really think about it, I know that you talk about the data and the stats and all that information, but basically if you break it down to people that are earning less money, and if they're not owning the property, if the properties are rented, obviously it has an impact. So if you're an investor, you want to make sure that those people can actually afford to keep renting that property. Your rents can keep moving along as they want. If you want to increase rents, stay with the market, you want to make sure that you're actually investing in the right location that people can actually afford to pay that money. So it's not just a short-term investment that here's a property now, it's worth this much and you get that much rent. It's long-term, and you want to make sure that you can keep getting that rent for that property and don't have all the headaches of tenants moving out and changing tenants all the time, and being able to get people in there as well. So understanding that household income and knowing those areas is critical. So
a couple of suburbs that have stood out to us as being, they have a higher proportion of lower income earners as opposed to the statewide or the national proportion of people. So we've got Caboolture. There's 21.4% of that suburb that are below that $650 per week threshold. So that's a much higher proportion compared to the state average. We've got Deception Bay, we've got Eagleby, we've got Sandgate, we've got Scarborough, and we've got Waterford West. All of these locations have a much higher proportion of lower income earners compared to the statewide average here in Queensland. And therefore, I think it's important to understand how those locations will perform in the future, because there's more and more more and more tenants in that area that are already in are already in rental distress. That is, they are spending more than 30% of their income on rental payments. So there's definitely got to be a cap in terms of what they can pay into the future because of the incomes that they are earning.
Now, just to remind people that the national average there is 16.5, Queensland 16.4, and those areas that Melinda mentioned are all ranging somewhere between the 20s to the 24, 25 mark. So considerably higher than what the average is as well. If we look at then what people more than $650 a week, Australia goes up to 24.3%. and Queensland 21.9%.
And again, here's a safe way to be looking at location selection, assessing the income, seeing what proportion of that population within a certain suburb are high income earners. Because when we look at the state average of 21.9%, any areas that are significantly higher than that will actually mean people can afford to pay more on their mortgage as interest rates rise. They can also afford to pay more rent in the future as the demand and supply pressures play out. So we've got some safer suburbs, if you like, based on the amount of income or the proportion of income earners that earn more than $650 per week. Some of those are Ascot, very high income earning area, with 37.7% earning more than $650 per week. We've got Barden as a very safe location, 55.4% of higher income earners. We've got Camp Hill at 51.6%. We've got Chelmer at 58.9%, Grange at 53.9%, Tarragindi again at 49.1%, Wavell Heights at 43.6%, and Wilston at 49.9%. Please remember, this is not an exhaustive list. We have just simply selected some of these locations just to talk through some of the information that you as an investor really need to be aware of. This is the sort of suburb level information that we collect in-house at Streamline Property Buyers for our clients to give them the best representation of what locations they need to be targeting for their investment strategy to ensure that they've got a low risk portfolio, but also to ensure that they will continually get not only capital growth if the broader economic conditions allow for that, but also rental price growth because of the current rental crisis. We know there's very low supply, but there's going to be an affordability cap for many of the locations. And in fact, we're already running into that and starting to see that in terms of just how far rental price growth can go in some areas based on affordability.
And some of those suburbs you just mentioned then, when you're talking, from 21 up to 55, 58, that's over double the average then for Queensland as well. So if we look then at, and obviously this is before interest rate rises, all of this information. So the rental side of things and the weekly payments, more than 30% of their weekly payments. If you look at Australia, 32.2%, and Queensland, 32.3%.
Yeah, so that is the proportion of tenants in a particular location that are spending more than 30% of their take-home income on their rental repayments. And that is an affordability threshold that is often talked about. So when we see, we've had rising inflation, so the cost of living expenses have increased. We've also had huge rental price growth in some areas across Brisbane. And I've actually tracked that according to the last 12 months of SQM research data for these locations. So when we look at 32.3% being the Queensland average of tenants that are in mortgage distress or that were in mortgage distress, or they're paying more than 30% of their take-home income towards rental repayments back in 2021 when this census data was collected, there are some locations that were already proportionally higher. So for example, Caboolture, 39.8% back in 2021 of tenants in that location were already spending more than 30% of their take-home income on their rents. Over the last 12 months alone, rental price increases have gone a further 13.6% in that location. So these numbers are outdated and they do need to be adjusted for the huge increase that we've already seen in rental price growth over the last 12 months alone. We've got Deception Bay as another location, 39.6% of tenants here already, or back in 2021, were paying 30% or more of their take-home income in rent, and rents in the last 12 months alone in that location have increased 18.2%. So there'll be a much higher portion of that population that are now in rental distress. We've got Eagleby at 38.9% of tenants in mortgage distress in 2021, with a further 19.3% increase in rents over the last 12 months. We've got Morayfield with 39.3% of tenants in mortgage distress in 2021, followed by 20.2% increase in rents just over the last 12 months alone. There's a couple of other suburbs that I'll mention. Sandgate, 40.2% of tenants already paying 30% or more of their take-home income in rent back in 2021, with 20.7% increase in rents since then. And 41% of tenants in Scarborough paying more than 30% of their take-home income in rent in 2021, with 13.4% further increases that have been experienced since then. One other I'll just add, Waterford West, 38.8% of that suburb were paying more than 30% of their income in rents back in 2021, and we've seen 16.7% increase in rents just over the last 12 months. These figures are alarming for some locations. These figures indicate that, there's potentially 40 to 50% of the population group in some of these locations that are really feeling it, and they're not able to afford to pay more in rent. And that's going to potentially put a cap on what the area as a whole can afford to pay. We simply can't continue to charge more if people cannot afford to pay more. And that's where I think we're going to see the biggest turnaround in the investor returns in the higher interest rate environment as we continue to push forward into 2023 and beyond.
Now that was all for rental side of things. So that was the rental payments. If we then move across towards the mortgage payment side of things, again, don't forget the interest rate rises that we've had. But if you look at the mortgage repayments, if we look to more than 30% of their income goes towards the mortgage repayments, in Australia, that's 14.5%. And in Queensland, it's 11.9%.
That's right. So again, this data's from 2021, the census data. It's before the 10 consecutive interest rate rises that we've had up until just recently. So if we've got 11.9%, or back in 2021, we had 11.9% of the Queensland population already paying more than 30% of their take-home income towards their mortgage repayments. There's some suburbs where that proportion is a lot higher. So, for example, in Crestmead, back in 2021, 14.3% of that population were actually already paying more than 30% of their income towards mortgage repayments. We've got Eagleby coming up again. 14.2% of that population were already paying more than 30% of their income towards mortgage repayments. Jumps for areas like Pallara, where back in 2021, there was already 18.7% of the demographic paying more than 30% of their take-home income towards those mortgage repayments. So these are areas where we can see the impact that those rising interest rates will have had on affordability. That number would have spiked since then. And this is why understanding suburb level demographics and mortgage data and rental data becomes imperative for you as a property investor. We've got areas such as Pimpama, 15.7% of that population were already in mortgage distress, defined by 30% or more of their take-home income being paid out in mortgage repayments. And one final suburb to mention there, Waterford West, where in 2021, 15.7% of that population were already in mortgage distress, defined as that 30% barrier. So really interesting information here, and absolutely critical for everybody to understand that, you know, a rising interest rate environment does not impact everybody in the same way. And it's something that we have discussed a lot on this podcast. Brisbane's not one property market. Australia's not one property market, but, you know, I think we need to get more granular with understanding different parts of a city to understand where you can find pockets where there's much higher risk and where you can find pockets where there's much lower risk. This is the sort of data you need to rely upon. And this information is all freely available. It just takes a lot of time to collect it. But once you have put it all together, it helps you to make much more informed property investing decisions and much more low risk decisions about where to invest your investment dollar.
And especially when you overlay them. I mean, that's the interesting part. When you look at the overlay for more than 30% of your income is spent on your repayments, and then you overlay that with the amount of percentage that's owned outright for a property. And when you're down to that 9-10% that's owned outright, but yet the amount is so much higher in your payments, it's not quite balancing. So I mean, people really need to do their homework. And as Melinda said, I hope everyone had their pen and paper out to take notes then. But look, if you didn't, obviously you need to reach out to Streamline Property Buyers to have a chat so we can help you understand where is the right location, because we do talk about this all the time. It's location selection that is critical when you're buying property.
Absolutely. And if your buyer's agent is not giving you this granular information, then I'd be asking them on what basis are they actually making the suburb recommendations for you. We're very big advocates for ensuring professionalism in this industry and ensuring you as the consumer are protected. And therefore, we're going to continue to unpack some of these value add episodes in our podcast to really help you understand what you need to be considering. And if you're not considering this level or this type of information, whether you're investing on your own or whether you're partnering with a professional, then I'd be starting to ask questions to ensure that you have or that they have your best interests at heart.
Yeah, avoid making mistakes and make sure you do all the work or get someone to help you that knows what they're talking about. So, look, I hope that was really, really helpful. There's a lot of information there and you get a bit of an understanding of what we do here at Streamline Property Buyers behind the scenes to try and help our clients avoid making mistakes and making the right investments when purchasing property. So, if you need your help, reach out. As usual, I will let Melinda wrap it up. Thank you very much for listening, and we'll chat again next week. Thanks very much, and bye for now.
Yes, I hope you've enjoyed this episode and the little gold nuggets of information that we've shared about some locations, areas that potentially are at risk and other areas that potentially are a little safer. If you would like help in selecting the best locations for yourself to ensure a low risk investment and to ensure you get results over the long term, please reach out to our team at Streamline Property Buyers. We are here to help, and we're very happy to guide people through the process to help them understand what is or what makes an A grade or a high performing investment property. As always, thank you so much for tuning in. If you've enjoyed this episode, please don't forget to share the episode with friends and family. Leave us a review on iTunes if you get the chance. We really appreciate that. It does help others to find our podcast. Until next week, we hope you have a good one. We will see you again then. Bye for now.